All right, let's look at a pretty aggressive way to pay off your mortgage in record time. And this is how much interest you could potentially save. That's a huge number.
So, how in the world is that even possible? It's all about crushing the timeline of the loan.
Yeah, you're seeing that right. Instead of 30 years, we're talking less than 6.
This whole idea is called cash flow banking. It's a model built for one thing: speed.
So what's the secret sauce here? It's actually a surprisingly simple formula.
Okay, for our example, let's say we start with a loan of $363,000.
The strategy really boils down to a 3-part payment system every single year.
So you've got your regular payment, a big extra payment, plus a yearly lump sum. All those extra payments, they create this awesome snowball effect on the principal. You can see how that balance just plummets, especially after that first big lump sum payment. Okay, so we've seen the how. Now for the really crucial part, the final numbers. The entire loan gets paid off in just 69 months. That's it. To put that in perspective, that's just 5.8 years versus the usual 30. So the total interest you end up paying is less than $42,000. Pretty good, right?
Which means you save a staggering $114,000 in interest. Just wow.
Now, this all sounds amazing, but hold on. There's a really important disclaimer we have to talk about.
Basically, this is just an example. It's a model, not a real quote you'd get from a lender.
Now, this model is definitely aggressive, but it does make you think, right? What could this mean for you?
Let's break down this insane mortgage payoff story. From 25 years down to just under 6. Yep, you heard that right. A $363,000 mortgage, totally paid off in only 5.8 years.
And get this, on top of that, they saved over $100,000 in interest.
So you're probably asking, how in the world is that possible? Well, the numbers tell the story. It all comes down to a super aggressive but simple 3-part payment strategy.
So you have your regular payment, a big extra monthly payment, and then a yearly lump sum.
And here's the secret sauce. Every extra dollar went straight to attacking the principal. This creates this incredible snowball effect. Okay, let's see how it actually works.
Just look at that huge drop in the balance when that first lump sum payment hits.
That's how you really supercharge your payoff schedule. It just gets faster and faster. All right, let's get to the final jaw-dropping numbers. I mean, the difference in both time and money here is just, wow, it's staggering. So with this plan, the total interest paid was just under $42,000. And remember, this wasn't a fantasy. It was just the result of a very disciplined plan. It really makes you wonder, right? What could a focused strategy like this do for you?
Let's talk about taking real control of your biggest expense, your mortgage. So let's be real. Does it feel like your mortgage is the one calling the shots? You send in that big payment every month, but have you ever wondered where it really goes? Here's the crazy part. In the early years, most of it is just feeding the bank interest. Seriously, it's like trying to walk up an escalator that's going down. It feels impossible. Okay, but what if you could flip the script and make that mortgage work for you? It's a simple, powerful strategy that puts you back in the driver's seat. It's awesome. Okay, let's get into it. There are 2 key ways you can supercharge your payoff. You can either add extra to your monthly payments, or you can make strategic lump sum payments. And here's the key. That extra money directly attacks the core debt, not just the interest. And that principal, that's the actual amount you borrowed. That's the real target we're after. This is where it gets really powerful. You're basically starting a massive savings snowball. I mean, just look at that difference. That's a fortune in interest you're saving. Because with every extra payment, that big loan balance starts to shrink so much faster. And because that balance is smaller, you pay less and less in interest every single month. So what's the result of all this? Simple. Total financial freedom. Think about it. You can own your home free and clear years ahead of schedule. You're not just paying off your house. You're saving a fortune in wasted interest payments. But it's bigger than money. This is about unlocking years, even decades of your future. So, the only question left is this. When you're finally free, what will you do? Ever wonder how you could pay off your mortgage in under 6 years? Let's dive right in. First, picture this, saving over $100,000 in interest. Yeah, that's a real number. And get this, being totally mortgage-free in just under 6 years. Sounds kind of crazy, right? So you're probably asking, how on earth is that even possible? Well, it all comes down to the strategy.
Okay, let's break it down. It all started with a totally standard $363,000 mortgage.
The plan is actually super simple. Just 3 parts: your normal payment, an extra one, plus a yearly lump sum.
And look at these numbers. You can literally watch that balance just plummet from month 1 to the end.
So why does this work so well? It's all about attacking the principal. That's the original loan amount. And here's the secret sauce. Those extra payments, they go 100% towards that principal. No interest. And that creates this amazing snowball effect. Every extra dollar you pay cuts the interest you'll owe later. And check this out. The interest paid in year 1 versus year 5, wow, what a massive difference.
The total savings are just insane. Over $155,000 in interest. Gone.
So what's the big takeaway? Your secret weapons are small extra payments and those big lump sums. Which leaves us with his final thoughts. Most banks sell you a mortgage, but very few show you how to get rid of one.
All right, let's break down how you could pay off your mortgage in under 6 years.
What if you could save this much in interest? That's over $100,000.
And get this, your entire home loan paid off in just under 6 years. Seriously.
So how on earth is this actually possible? Well, let's dive into the data.
Okay, first things first, we need a starting point. Here are the initial loan details.
So those are the baseline numbers, but the real magic is in the strategy.
The secret sauce? It's a simple but super aggressive 2-part payoff strategy.
First, you make extra payments every month. Then, you add a big lump sum once a year.
So check this out. An extra $3,000 hits the principal every single month.
But that's just part 1. Let's see how the second step really speeds things up.
And here's the kicker. Once a year, a $10,000 lump sum demolishes that balance.
This whole thing creates what's called a financial snowball effect. It's incredibly powerful.
Now, this is where it gets really fun. Let's look at the interest payments.
You can see the huge shift from paying interest to actually paying down your home. Just look at this. Monthly interest drops from over $1,000 to just over $100. And that's the whole point. Your money is attacking the principal, not just feeding the interest. You can just watch that balance melt away year after year. It's an amazing timeline.
So what's the bottom line? Let's check out the final numbers. This is your money reclaimed.
A normal loan would cost you over $155,000 in interest. This strategy, just over $41,000.
That's a total savings of more than $114,000. That's your money. Now, of course, keep in mind, this is just an example, not a real lender quote.
But the key takeaways here are just incredibly powerful for any homeowner to consider.
So yeah, this is way more than just data. It's a potential blueprint for financial freedom.
Which leaves us with one last really exciting question to think about for yourself.
Look at this. By 2026, about 60% of Canadian mortgages will renew, and many homeowners could see their payments jump 15 to 20%. But here's what most people don't realize. There are a few strategies that can dramatically reduce that increase. Let's break it down. Something big is approaching for Canadian homeowners. Between 2025 and 2026, roughly 60% of mortgages across Canada will renew. Many of those mortgages were taken out during 2020 and 2021 when interest rates were historically low. When those mortgages renew, many homeowners may face payment increases in the range of 15 to 20%. Economists call this mortgage payment shock. But here's the important thing. Payment shock isn't inevitable. With the right preparation and strategy, many homeowners can reduce the impact significantly. Now, here's the part that surprises many people. The increase in payments isn't caused by just one factor. It's actually the combination of 3 forces happening at the same time: interest rates, timing, and something called amortization reset. Let's walk through each one. First is something economists call the renewal wave. During the pandemic, millions of Canadians locked in the 5-year fixed mortgages. Now, those mortgages are approaching maturity at roughly the same time. That means a large number of borrowers will be renewing their mortgages within a very short window. Both the Bank of Canada and federal regulators have flagged this concentration of renewals as a potential financial stress point for households. The second factor is rate reset math. Even if interest rates fall somewhat before 2026, many mortgages will still renew about 1.5 to 2 percentage points higher than the rate borrowers secured during 2020 and 2021. According to Bank of Canada modeling, that difference alone can create payment increases in the mid-teens to near 20% range. But there is a third factor that many homeowners don't realize affected their mortgage. Some variable rate borrowers kept their payments unchanged when interest rates increased between 2022 and 2024. Instead of their payments rising, their amortization quietly stretched longer. That means less principal was being paid down each month. When those mortgages renew, lenders often reset the amortization schedule. That reset can cause payments to rise even more. So payment shock isn't just about interest rates. It's about the combination of rates, amortization, and timing. If your mortgage renews in the next few years, there are 4 things worth checking right now. First, confirm your mortgage maturity date and your current balance. Second, estimate your renewal payment using today's rates plus about half to 1% as a buffer. Third, review your amortization schedule to see if it extended due to variable rate changes. And fourth, look at your total housing costs. That includes property taxes, insurance, utilities, and maintenance, not just the mortgage payment. The good news is that there are several strategies that can help reduce renewal pressure. Many lenders allow rate holds up to 120 days before renewal. That can protect you from rate increases before your renewal date. Adjusting amortization can also provide temporary relief. For example, extending from 25 years to 30 years can reduce the monthly payment and create breathing room. Prepayments can help as well. Even modest lump sums before renewal reduce the balance your new payment is calculated on. And it's always important to compare multiple lenders. Different lenders can offer very different renewal options depending on your financial profile. Let's look at a simple example. Imagine someone who took a $500,000 mortgage in 2021. By 2026, their balance might be around $425,000. If their renewal rate is roughly 1.75% higher, their payment might increase around 18%. But with a small prepayment and a slight amortization adjustment, that increase could drop to under 10%. Preparation makes a big difference. Mortgage renewal pressure is coming for many Canadians, but homeowners who prepare early usually have far more options available to them. If your mortgage renews in the next few years and you want to